Hey guys, hope you are well. There's my head. Sometimes it just pops up in these random places. Just doing a some research for tomorrow's whiteboard video that I'm going to do on a silver short squeeze. We all know what's been happening with GameStop, but now Wall Street Bets is changing their direction slightly. They're moving their attention to silver, and a lot of people are talking about it. I know Schiff was talking about it on his podcast yesterday, so if you haven't checked that out, definitely do so. Yeah, or maybe it was Saturday, something like that. But it was a good one. Obviously, Peter has a lot of insight because he owns a gold and silver dealer. But I wanted to go over the basics. This is a pretty good article. It's youshouldbuygold.com/naked silver shorting. You can probably see the URL here. And I'm going to be probably using this in my video tomorrow. So I wanted to go over just the basics so you guys could start to understand how this silver short squeeze could play out. I know a lot of us are precious metals investors. I'm more into gold than silver just because I see gold as more of an insurance policy and silver is more of a speculative asset. I'm not saying that's right or wrong. It's just kind of the way I see things. And I think the big difference between GameStop and silver is, and Schiff makes this point, is silver. I like the underlying asset. GameStop. I don't really like the underlying. I mean, you're kind of buying a business and it's a turnaround. I get it. I get it. But I think you're buying $1 for $3, hoping it goes to $5 with GameStop, even minus the short squeeze. But with silver, I think it could be considered cheap when you look at M2 money supply. So I like the underlying asset a lot better in silver. That said, I don't know if you guys watched my live stream last night on my George Gammon channel, but I would never, and I'm not saying this is right or wrong, just me personally, I would never buy a stock just because I thought there could be a short squeeze. No way. I would only buy it because I was very bullish on the underlying asset. I thought it was cheap or it's paying me to own it, something like that. You guys know my 10-80-10 portfolio and my philosophy of just buying things when they're cheap, selling them when they're expensive. And if I just happen to get caught up in a short squeeze, okay, fine. I guess icing on the cake. But I would never go in and buy something just for the sole reason that I thought there'd be a short squeeze on it. But so how does this work? You guys, I'm going to assume you know kind of how short selling works. It's basically you borrow shares to sell into the market at, let's say, $10 because you think the stock's going down. And in a week, it goes down to $5. You buy those same shares back at $5 and you pocket the spread. That's pretty much how short selling works. A little different, slightly different with commodities in the sense that they're selling futures contracts, and you can buy futures contracts where at the expiration date, then you can usually people sell the contract prior to that, keep rolling them over, but you can actually say, yeah, I want my 1,000 or 5,000 ounces of silver that I bought with this contract. And what this article explains is some of these banks, and I'm sure other people as well, sell what they call naked shorts. So they're not really, in the case of the stock, they're not really borrowing any stock. They're just selling what they don't own, and there's some gray area there on whether that's legal. And a lot of people have talked about the metals market being manipulated by naked short selling, meaning that they're just creating a random contract and saying, selling it into the market. And the amount of contracts, if you took the total amount, it's more than the amount of silver or gold available. Now, I want to be clear. A lot of people get focused on that happening with gold and silver, but it really happens with pretty much all commodities. If you look at oil, I mean, my goodness, the amount of derivative contracts for oil vastly exceeds the amount of oil available at any given time. So it's not just gold and silver, but let's talk about silver because that's what it looks like the Reddit guys are starting to target next. So usually if there's, let's right here, when it goes down to, I should have highlighted this. Let me see if we can highlight this real quick. It's not working. This little highlight app I have, it's got a mind of its own. There we go. Okay, so now it's just randomly turning off. You see what I'm dealing with here? Fails to deliver. Shorts are squeezed during rising markets when covers are impossible to find. So they're creating a contract, selling it short into the market. Then they have to buy the contract back, or that to buy the physical silver, or they have to buy the silver. If they sell a contract, someone buys the contract, the futures contract says, okay, I want delivery of the silver, right? So the person that sold them the contract or sold it short, they don't have the silver. So let's kind of outline this to make sure you guys are understanding what I'm saying here. It is called fails to deliver when bullion houses are unable to secure the silver or gold to fill delivery orders. So just, again, you buy a futures contract for 5,000 ounces of silver. They sell it to you. They don't have the silver. And at the end of when it expires, you say, okay, great. I want my silver. Where is it? And they say, I don't have it. So when that happens, which it looks like it happens from time to time, when demand overwhelms supply, the exchange has a clause that allows for a cash settlement instead of delivery of physical metal. So if they don't have the metal, they say, okay, what do we owe you? We can't give you the silver. So the dollar amount equivalent would be whatever, $100,000. Here's your 100,000. The default mechanism for fails to deliver is a cash settlement since 2011. Okay, got it. And sometimes they have to pay you a premium based on the contract, sometimes 20 to 30% just to settle. And then it talks about the banks who are kind of the market makers that do this consistently. That would be JP Morgan, HSBC, Barclays, Scotiabank, Deutsche, and SocGen. I think that's a French bank. I know that's short for something. But all of our favorite banks, basically the banksters, are right in the middle doing this. So I think the guys on the Reddit forum have said, yeah, let's this Melvin Capital was the big hedge fund that kind of took a hit with GameStop. And they're saying, yeah, let's do this with the silver market so we can make JP Morgan deliver on silver they don't have. And then they'll scramble to find the physical silver, which drives the price higher. And that's kind of your short squeeze type of action. It'll create maybe this volatility. You got to listen to Schiff's podcast because he talks about this being a lot harder with silver than it would be with GameStop because the market for silver is so much larger. So it would require more money, more people kind of crowdsourcing their effort going into it. But it is a very interesting phenomenon. And I personally think this is an indication that the market is just, I'm not talking about the silver and gold market or anything, but just the stock market is just in a massive mania, hysteria type of bubble. Exact same stuff you saw at the end of the 1990s, exact same type of stuff we saw with housing in 2006, 2005, 2006. It's there's so much emotion, and people aren't even buying for the underlying value. There's trading this volatility. It might not even, it might as well not even be a stock. I'm talking about GameStop. It might as well just be some like casino game that people are playing with some made up. It's like a made up game where you just have two parties that are going back and forth, just trying to outbid each other and out short sell each other. It really has nothing to do with stocks or with real life companies. Again, it's just like a casino game. And I mean, some people will say, George, you don't get it because it's all about fighting hedge funds. And no, I get it. Trust me, I get the narrative. I get the crusade, but I think if we take a step back and look at what all of this frenzy, whether it's right or wrong, is telling us about the economy and the market, it's really saying the fourth turning. We're seeing it play out in real life. I think that's the main message. But the point of this video, without getting off on a tangent, is to kind of give you the basics for how this short squeeze in silver may play out. And again, it would be very difficult for the price move to happen as dramatically as it did with GameStop, but we shall see. And I'm going to keep studying, keep figuring it out, using articles like this, and turn it into a whiteboard video on the George Gammon channel for tomorrow. So definitely stay tuned there, and probably do another video on this, and maybe even another live stream or a live stream today on the Rebel Capitalist channel, just taking just going into this further and trying to explain this as I get more and more information, and then maybe doing an update on GameStop and then the overall market. So see you on the next video.